Hello guys and welcome to my way to fire. This video is about peer-to-peer lending, how it works, what interest rates you may expect, and if it is a good option to invest. Before we get into that, make sure to drop a like on this video to help out the channel if you think it deserves it. First, let's start with the borrower. When a person wants to borrow money, they can either go to a bank or use the services of a different company. There are two main reasons to choose a lending company instead of a bank. The first one is that the bank rejects you. That can happen to people with bad credit scores, people who already have a lot of debt, etc. If that is the case, then the borrower might try a lending company that will provide the loan, but at the same time it will probably cost them more in the form of a higher interest rate, due to the higher risk. The second reason could be that the lending company just offers a better deal. There are some lending companies that actually want to compete with banks and offer solid interest rates in the single-digit range. So if the loan is approved, the borrower gets the money from the lending company. That is because they do not want to make the borrower wait, otherwise they would be at a disadvantage against the banks. After that, there are two options again, but this time concerning the investors. Option 1 is when the lending company also has its own platform. Both the borrowers and investors are directly tied with the lending company. Borrower gets their money and after that they send the repayments to the lending company. The interest rate will depend on the lending company's internal process of evaluating the borrower and deciding how risky the loan is. After a loan is issued, it becomes available to the investors. They can either invest manually, which can be time-consuming, and they will only have very limited information about the borrower anyway. If the platform supports it, it will have an auto-invest feature where you set up what you want your portfolio to look like and save yourself some time. When it comes to liquidity, it can be tricky and different with each platform. The maturity of the loans can vary from just a couple days to a couple years. To make the liquidity issue smaller and the platform more attractive, secondary market can be put in place. On secondary market, investors can sell the loans they invested in. Again, depending on the platform, a premium or a discount might be added if the investor decides to do so, and this feature is supported. The second option comes in the form of a marketplace. That is when a lot of lending companies come to a single platform to offer investing in their loans. That saves them the cost of actually making their own platform and maintaining it. They can even put their loans on a marketplace like this while also having their own platform, just to get a bigger reach and access to more money. With many loan originators like this in one place, you need to be careful which ones you choose, because chances are there will be a huge difference among them. From payday loans with huge interest rates to something in the middle, and also strong companies with good loan portfolios. From loans with a maturity of only a couple days to many years. There are two different interest rates when it comes to these loans. The one the borrowers pay and the one investors get. It goes without saying that the first one is higher since the originator takes their cut. Of course, that happens as well with the platform of a single originator. But this time the difference is bigger because the interest rate for investors depends more on supply and demand rather than how risky the loan is. The marketplace should have some form of ranking, or I recommend you to try to find some online reviews to know which loan originators are the stable ones and which ones are the risky ones. But as I said, what determines the interest rate for investors is supply and demand. When the marketplace is full of loans and loan originators need to compete for investors' money, they will offer a bigger cut of what they make on the loans. On the other hand, when there are fewer loans and investors are the ones having a hard time to keep their money invested, they can offer smaller interest rates to them. This applies to all of the loan originators, although there will still be a difference if you invest in a riskier lending originator and into a stable and well-established one. So what range are we talking about? This is actually really hard to say as it fluctuates a lot. When it comes to the big companies that want to rival the banks, you can expect to make around 5 to 8% annually. Of course, that can be lower if you only want to invest in the safest loans. It might also be higher if you invest only the riskier ones. The average should work for a balanced portfolio. On the marketplace, where the interest rates are driven by supply and demand, you can expect to make even 12% annually if you invest in the riskier ones, or if the demand for investors' money is currently high, then 12% can be the average and the riskier ones can go for around 16%. If the demand is low and you want to stick with the better originators, it can go as low as 6% for the good ones. If it comes to this and they don't need your money that much, on some platforms they can repurchase the loans from you. So naturally they will repurchase the ones with the highest interest and sell new ones with a lower rate. That can be frustrating sometimes. It can also mess with your auto-invest, and you either have to check the situation often and adjust to the interest rates available or settle for lower ones. Why do the lending companies want our money anyway? Why don't they just lend the money by themselves and keep all of the profit? Well, that is because this way they can make money on the investor's money. They lend it to the borrower for higher interest than you lend it to them, which is basically what's happening in peer-to-peer lending. It sounds as if you lend the money to an individual person, but in fact you are lending it to the company which uses it to serve more customers and make more money. This way they have a source of funding. Apart from this, some of them also issue bonds. How does repaying the loans work? As stated before, you are not really in touch with the borrower. You don't have any information on them. Gender, age, country, maybe a field of their job depending where you invest. In my opinion, even if you have this information, it doesn't really matter. You can't make a decision whether to invest in the loan or not. That is what scoring is for. You should either decide on your risk tolerance and choose loans to invest in based on the interest rates if they are different for the company, or choose the right companies on a marketplace. But back to the question. The platform serves as the middleman who collects repayments from the borrowers and distributes them to the investors. So you get a monthly payment in the form of principal and interest. What's nice about these monthly payments is that you can take advantage of the compound interest and add more loans every month. Another important aspect of peer-to-peer lending is what happens if the borrower does not repay the loan. Again, this varies depending on the platform. A lot of them offer some sort of buyback guarantee. This claims that the loan originator will buy back the loan if it becomes late. For how long it has to be late to trigger this guarantee differs, but it can be around 60 days. How does it work, and how can the loan originator afford to buy back a loan that doesn't pay? First of all, if they offer this, chances are they charge the borrower a lot more than they offer the investor. That is to make enough profit to be able to cover those expenses. Also, the loan might start to be repaid again even after you already got your money back. The word guarantee here is a tricky one because it makes you feel safe about your investments and might make you chase those high interest rates from poor companies because, hey, it comes with a guarantee, right? Well, yes. But actually no. The guarantee works until it doesn't. What I mean by that is that the guarantee is only as strong as the lending company which provides it. If they get too many junk loans that stop paying, they will simply not have the money to cover for it. And nobody will do it for them. That means nobody will do it for you either. When that happens, things will get really slow. Now, what matters the most is how bad the situation is. Is the company just having some trouble, or is it going down? After any news about such situation, things get both quick and slow. Quick in terms of spreading the news and probably a ban from selling those loans on the secondary market. Slow when it comes to collecting money. Should the company go down, another authority will be assigned to take care of the loan portfolio and borrowers' repayments. Best case scenario is that the repayments will go smoothly and you get your money back. Worst case, you lose all of the money. And of course, somewhere in the middle, you get a part of what you invested. This is why it's important to mostly choose the strong, stable loan originators, because there have been some cases of defaulted originators. If the loans don't come with any sort of guarantee, then it's just your portfolio. Whichever loan defaults stops paying. How to prevent that from costing you more money than necessary? Diversify. Check what the limits of investing in a single loan are and stick to the bottom limit. Split your money into as many loans as possible to ensure you are well diversified and you rely rather on statistics than pure luck. Also, diversify across different interest rates and make sure you don't just invest in the high interest ones that are also the risky ones. Higher reward means higher risk, and those loans will definitely have higher default rate. So what are the takeaways from this video? Peer-to-peer lending might be a good option if you want to diversify your portfolio. I personally have some money invested in peer-to-peer lending as it was what got me started investing in the first place. But after that, I don't add more money into it and just keep reinvesting what I make. If you choose to invest into this, make sure you choose the right platform for your needs and the right loan originators so you don't lose more money than you make. Also, diversify across many loans and don't put all your eggs into one basket. If you enjoyed this video, please give it a like and let me know down in the comments what you think about peer-to-peer lending. If you are interested in more videos about investing, personal finance and financial independence, then make sure you subscribe. Thank you so much for watching, and I hope to see you in the next video.